Now, after that parabolic run, gold is pulling back. The big question now is whether this marks the end of the rally or just a breather before the next bull phase. Is this a warning sign or a golden buying opportunity? Let's take a closer look. All right, let's start off with a chart of gold here. Now, we did an update on gold just 3 days ago, right at the market top. And since then, we've seen the beginning of a correction. Now, so far, this market correction is still meet all of the criteria of a typical pullback, which is that you would see about a 50% retracement or so. You can see the 61.8 retracement very close to 3,200. The 50-day moving average is all the way down at 3,100. Now, when we break gold down to a 4-hour chart, what you can observe here is that we're in the midst of a zigzagging formation and a B to C pullback here, which is the typical kind of drop, goes right to 3,200, where that 50% retracement lies. And so we have we're at a very important technical crossroad. If this is a buying opportunity and a short-term buy on dip, then what we should see is the 3,200 level hold, and then we should see the bull continuation pattern continue, where we would make a punch to 3,600 or plus. So this is the bull scenario, and the one thing I'll highlight: it shouldn't take more than a few days for this correction down towards 3,200 play out and the buying opportunity emerge. Now, what would be the more kind of the technical scenario from which the swing high is in on gold and some bigger multi-month market correction is underway in gold? And that would be where the 3,200 level doesn't hold. It would start with a V-shaped drop that basically wipes out the entire last rally. When we have that, that will inevitably bounce, and you'll see, let's say, gold rally back towards, let's say, the 3,200 level. If this scenario developed, then odds are that gold is going to be spending months in a deep consolidation. I want to just reference what happened the last time we had gold hit this kind of a high. And you can, let's say, look at, for instance, the bull run that gold had back over here in August. And after that run on the upside, it had a very deep correction that didn't hold the 50-day and didn't hold short-term Fibonacci zones. And when that broke, it began a period that was basically a 3-month period where gold did one big horizontal triangle. I want to highlight that just because there might be a short-term high in gold or even an intermediate high in gold doesn't necessarily make it bearish or a shorting opportunity. It just means that you'd have to curb your enthusiasm that gold is going to make immediate money. And you'd have to realize that it would then be a scenario where gold will probably only rally in the second half of the year. But these types of consolidations are definitely possible. So whether that happens or not is literally going to be decided by the 3,200 level on gold. It's a very tactical place for a short-term buy on dip to see whether the level holds, because it's asymmetric. You can take a small risk, find out whether it holds, and get out if it's not. Now, how does this translate to gold miners? Now, gold miners also had a great run. They finished a measured move to the upside towards that $52 to $54 zone, and we're doing the same retracement. Literally, the gold miners should be in lockstep with gold. If gold was going to find support at 3,200, then the gold miners are going to find short-term support in this $45 to $47 area for the next buy on dip. And if gold is going to go through a multi-month correction, then similarly, the gold miners are just going to follow suit. They're going to drop down to the low 40s and stay in a muddled range that is going to be a prolonged multi-month scenario. So which one will prevail? I mean, I would say give the bulls the benefit of the doubt. at this moment, assume that they will buy the dip on the first little pullback. Why? Because the trend has been so strong and there's a true fundamental macro reason running behind it. And so kind of speculating that this is when that all unravels, I'd rather kind of be stopped out of a position and then recognize that it's a bigger, more prolonged correction than to miss the next buy on dip. And so I'm going to be watching closely what happens in that area. And just one last comment, I want to just touch on silver. Silver never made a higher high. Now, first of all, it had a margin washout during the crash event when the whole stock market was getting its tariff tantrum, and while it was a huge $6-7 wipeout on silver in a short period of time, silver has only managed to really recover a good chunk of that, like a $5+ rally. Overall, the fact that we don't see breakouts to 52-week highs and momentum, I still think that it's very likely silver is going to be stuck in this trade range. While we could have a short-term pop to 35, odds are reasonable that a pullback to 31 is also very possible, and that you should be expecting this to grind out. Odds are at this point that we're going to end up seeing at some stage that gold consolidation, and then silver will be consolidating, and the next major bull run in silver will probably be when gold breaks out in the second half of the year. And so at this moment, I'm a little bit more neutral silver. I'm not bearish. I'm not shorting it. I don't think it's going down. I just don't think that where the action is in silver. Focus on the golds. That's where I want to end that. Those of you that want to get these kind of updates every day, this is what we do at Big Picture Trading. In the links below is our free trials to our website. Thanks, everyone.